If you've been watching the markets, you've seen it. Gold prices have been on, well, a pretty significant run through the 2020s, hitting these new highs that grab all the headlines.
They always do.
And if you're a thorough investor, you're probably asking the big question, have I missed the boat here? Or does it still make sense to really deep dive into gold?
It's the question that just never goes away, right? Especially when things feel uncertain. So our mission today is really to use the sources you provided, these financial reports, even regulatory warnings, to, cut through the noise.
Separate the hype from reality.
Exactly. We need to dissect the real value of gold versus the hype that's fueling everything from, all those online ads to some frankly dodgy sales pitches.
And we should probably just hit that tension right at the start, because while we're exploring the merits of gold, you have regulators shouting warnings from the rooftops.
Oh, absolutely. The CFTC, the Commodities Futures Trading Commission, they published this article with a really blunt title.
I saw that. It was something like, gold is no safe investment.
Yeah.
Just laid it right out there.
Right. And they're pointing to a significant rise in fraud. These cons making claims that gold is somehow completely risk-free.
Which nothing is.
Of course not. And they are absolutely right to warn people about high-pressure tactics or promises of guaranteed returns. Those scams are real. But, and this is the key, that doesn't invalidate the asset itself.
Right.
The core truth, for experienced investors anyway, is that gold can be a profoundly prudent way to diversify a portfolio. It provides these unique safeguards against very specific economic pressures.
Okay, so our deep dive is really going to focus on confirming two key ideas. That gold is seen as a store of value and, a powerful hedge against inflation.
And we'll map out the ways you can actually invest.
Yeah, from the tangible stuff like physical coins and bullion all the way to the more complex derivatives, ETFs, and mining stocks.
But we have to start with a reality check. It's one that gets missed in all the headlines. So while gold set a new nominal price record in 2024, the sources are clear. When you adjust for inflation, the actual historical record was set way, way earlier, back in 1980.
Wow, 1980. So what would that be in today's dollars?
It's estimated to be about $3,200 in 2024 money. So the true peak is, a lot further in the rearview mirror than many people realize. Gold has definitely disappointed investors in different periods.
That really reframes the whole conversation. It forces you to ask, if it has such a volatile past, why does it have this enduring appeal, both psychologically and financially?
To get that, you have to go way back.
Let's do it. Its history as a valuable thing is, well, ancient. It predates the Egyptians. But its use as an actual currency, a standardized one that really took hold around 560 BCE.
And that standardization was everything for early trade. Merchants needed something reliable, something easily transferable.
And that carried all the way through the Greek and Roman empires. By 775 AD, Great Britain had formalized a gold-based currency that really became the foundation for global commerce.
So when the U.S. was founded, we just jumped right into that system. We set up a bimetallic standard in 1792.
Meaning every unit of money was backed by a fixed amount of either gold or silver.
Exactly. The sources mention that $1, for instance, was explicitly equal to 24.75 grains of gold.
And that system, the classic gold standard, it gained huge acceptance across the world in the 19th century. The UK, the US, Germany, Australia.
Yeah, they all tied their currencies to it.
And the whole point was to guarantee monetary stability.
But that stability proved a little fragile. The first big crack came in 1914 with World War I.
Right. Countries needed to finance this massive war, and they couldn't do that if their money supply was strictly limited by the gold in their vaults. So they just suspended convertibility.
They started printing money.
They had to. Then, of course, the knockout blow was the Great Depression. As economies just collapsed, governments needed immense flexibility. The gold standard was a straitjacket. So in 1933, President Franklin D. Roosevelt officially abandoned it. And then the Gold Reserve Act of 34 ended the minting of new gold coins altogether.
But the story wasn't quite over on the global stage. In 1944, you get the Bretton Woods Agreement.
Right, which set up a whole new world financial order.
Yeah.
The U.S. dollar became the world's reserve currency, and its value was convertible to gold at a fixed price.
It was sort of like gold standard light. Other currencies pegged themselves to the dollar.
And that system held until 1971, when President Nixon ended the dollar's direct convertibility to gold.
And that was a profound moment. It effectively ended the entire era. Today, we're in a global fiat currency system. Money is backed not by a commodity, but by the trust and credit of the government that issues it.
So if gold no longer dictates the value of our dollar, why are central banks still aggressively stockpiling it? Why is it still such a big deal?
That's the fascinating paradox, isn't it? Central banks and these big multilateral institutions, they collectively hold almost a fifth of the world's entire above-ground gold supply.
A fifth. That's
Yeah.
huge.
And what's really significant is that many of them are actively adding to those reserves right now. And they're citing concerns about, the long-term stability of the global economy.
You have to wonder, if fiat currency is so stable, why are these sophisticated players hedging with this ancient, non-yielding asset?
And that question leads us right to the 5 modern pillars of gold's value. The first one is its role as a powerful store of value.
There's a great analogy for this in the source material.
It's perfect. Imagine the early 1970s. 1 ounce of gold was worth $35. That $35 could buy you a brand new, high-quality business suit.
No.
Today, 1 ounce of gold at its current price would still buy you a new, high-quality business suit. But that original $35, it buys you what, maybe lunch?
Yeah, barely. That is a stark way to show how it's preserved purchasing power against that slow, constant creep of inflation.
Which brings us right to pillar 2. Gold as a hedge against inflation. Historically, when inflation rises, investors, they lose faith in paper assets and that money moves into hard assets. Gold typically appreciates then.
The 1970s being the classic example of that.
The ultimate case study. Then you have pillar 3, which is the hedge against the U.S. dollar.
Okay, how did that work?
Well, since gold is priced in U.S. dollars everywhere, a decline in the dollar often boosts gold prices. It happens for 2 reasons. First, central banks buying gold often have to sell dollars to do it, which pushes the dollar down.
And second,
A cheaper dollar just makes gold more affordable for investors who hold other currencies. That directly increases their demand, which pushes the price up.
we saw a real-world example of that in 2024, right? With Egypt.
A perfect example. As the Egyptian currency was under severe pressure, local Egyptians flocked to gold. It was the most reliable way for them to preserve their wealth, which was just eroding so rapidly.
So that local crisis helped drive up global demand. Next up is Pillar 4, the classic safe haven asset.
The go-to. Gold is the asset of choice during political upheaval, economic uncertainty, collapsing empires, you name it. Investors run to gold when the news hints at some deeper instability.
And we've had plenty of examples in the last quarter century.
Yeah. We saw spikes after 9/11, the 2004 Iraq invasion, obviously the huge market fears during the 2007-2008 financial crisis, the pandemic, and definitely the war in Ukraine.
These are all moments when risk just vanishes and people want safety in hard assets.
Precisely. And that brings us to the final one, pillar 5, diversifying investment. This might be the most critical piece for a well-rounded portfolio.
Because it's non-correlated.
Exactly. It's largely non-correlated to stocks, bonds, and real estate. So, in simple terms, when the stock market is crashing, gold often moves independently. It provides essential balance and can reduce your overall portfolio volatility.
Okay, so if you're convinced by those 5 pillars, the next question is how?
Yeah.
How do you actually go about buying gold?
Right. And the landscape today is just a little more complex than it was for those merchants back in 560 BCE.
Just a bit. So let's walk through the options and think about who they're for. We should start with the most intuitive one. Physical gold. Coins. Bars. Bullion.
The advantage here is emotional and it's practical. It's tangible. It's a direct inflation hedge. But the trade-off is pretty significant. You need secure storage.
A home safe, a bank vault.
And that comes with ongoing costs, insurance, protection. All of that cuts into your return over time.
Okay, so on the other side of the spectrum, you have the indirect methods, like gold funds, ETFs, and mutual funds.
Right. These offer fantastic liquidity. You can buy and sell them instantly. They offer diversification, professional management. The big catch, though, is you don't own the physical metal directly, and you're paying management fees.
Then there's a totally different category, gold mining stocks.
And this is key. It's not an investment in gold. It's a leveraged bet on the gold industry. If the price of gold rises, the profits of a well-run mining company can rise even faster.
Which means potential for huge returns, maybe even dividends.
If it's a well-managed company, yes. But the flip side is they are high risk, very volatile. Their success is tied to the price of the metal, but also to all the risks of mining.
Like labor issues, political instability, in whatever country they're in.
Environmental regulations, and crucially, company debt. If you're looking at mining stocks, you have to do deep research into companies with strong cash flow and manageable debt.
And then you get into the really complex, high-risk stuff, derivatives.
Gold futures and options. This is for sophisticated investors only. people with a very high risk tolerance. They let you leverage a small amount of capital for potentially high returns, but you have to have a deep technical understanding of those markets.
We should probably mention a couple of other options too. Gold certificates.
Yeah, they're basically paper documents that confirm you own gold that's being stored by an issuer like a bank. So you get the price movement without the hassle of physical storage.
And some places offer gold-based savings plans.
Right, which let you accumulate small amounts over time, all stored securely. And finally, there's gold jewelry.
Which I think most people would see as an investment.
But
Right.
you have to be careful. It has aesthetic value, it's tangible. But the high markups and manufacturing costs mean it often has a pretty low resale value compared to what you paid. You're buying craftsmanship, not a pure commodity.
It's also useful to compare gold to its peers. So what about silver?
Silver is similar, but different. It has a much smaller market value, so it tends to be far more volatile, and its price is heavily influenced by its industrial uses, which are extensive.
So diversify between them.
That's the consensus view, yeah. It can help mitigate the unique risks of each.
And now for the modern debate. Gold versus Bitcoin.
This one really just boils down to your financial temperament. Gold is for stability, wealth preservation, hedging against, established economic problems.
And Bitcoin is for.
Bitcoin appeals to those who can accept extremely high volatility and risk, all in exchange for massive potential returns and a belief in the future of, digital decentralized finance.
The sources seem to suggest diversifying across both.
Exactly. It can mitigate the unique risks of each while letting you capitalize on two very different kinds of hedges.
Okay, let's pivot now to the downsides. Because, as the CFTC pointed out, nothing is risk-free. What are the major trade-offs we have to be aware of?
Well, the most immediate risk is just price volatility. Gold can, and it does, fluctuate significantly over short periods. Its value can be tough to predict because it's driven as much by emotion and fear as it is by fundamentals.
And while we talk about it being this great inflation hedge, we have to stress there's no guarantee, right?
Absolutely no guarantee that its price will increase alongside inflation in the future. It's a historical tendency, not a law of physics.
What else?
Its price is incredibly susceptible to global political upheaval. Wars, elections, sudden policy changes, those things translate instantly into price swings. And if you go the physical route, you can't forget the rising costs of storage and insurance.
They can quietly eat away at your net returns over the years.
Substantially. So ultimately, the decision has to be tailored to you. Your risk tolerance, your financial goals, your outlook on the world. Consulting a qualified financial advisor is just the prudent thing to do.
Makes sense.
And a quick point that came up a few times in the sources, just a modern note on the frustrations of doing all this complex research.
Okay.
When you're digging into detailed analysis, especially on those complex derivatives or specific company balance sheets, you hit these dense web pages or data portals. And sometimes you just can't access the data properly unless you ensure all the advanced web features like JavaScript are enabled in your browser.
It's a small technical hurdle that can just stop your research cold.
It's the hidden friction of doing a real deep dive.
So, circling back to the bottom line on gold, it is fundamentally a prudent choice for diversification. It's a hedge against inflation and a protector of assets during uncertainty. It adds that critical balance to a portfolio.
But the timing matters. As we talked about with that 1980 inflation-adjusted peak, there are better and there are worse times to get into this market. The decision has to be strategic, based on a critical assessment of your own goals, not just what the headlines are screaming.
And we'll leave you with this provocative thought to explore on your own. Gold's enduring stability comes from its ancient history as tangible money. But its future strength really relies on the behavior of central banks. So when you consider that these massive global institutions are actively adding to their gold reserves because of long-term economic concerns, what does their continued faith in this non-yielding metal really suggest about their confidence in the stability of our modern floating fiat systems? That's the question you should be pondering as you plan your next move.